Okay, I think we'll get started right now. There's a few people that'll join late tonight to go through the details, so we'll let them join in progress. I just want to thank everybody for coming out on behalf of Perch and Rent Panda as we're handling this webinar together as panelists. For those who don't know and haven't joined before, we're essentially putting together a speaker series as Rent Panda. And what we're trying to do is advise on an educational series of experts that come in to help along with your rental journey. So that would be anywhere from starting in the investment all the way through to, you know, what you're doing with your rental property, all the way in the actual rental cycle itself. So right now, the topic that we're going to cover is, and as everybody has known, is that, you know, in the time of rising interest rates and increasing mortgage payments, we want to support your rental journey. And the topics we're going to talk about, and what we're talking about today, is how to break down costs step by step on your next residential investment. And really, I'd like to welcome our panelists at this time. First and foremost is Alex Leduc. And Alex, if you don't mind saying a little bit about Perch, that'd be great. And then Hart just right after.
Sure. Thanks, Rob. Appreciate the intro. So as Rob mentioned, so I'm Alex. I'm with Perch. We are a digital mortgage platform. And really, we help do two things. How do we get first-time home buyers into their first home? And then how do we help homeowners build equity through real estate? So one of our core markets is real estate investors, and we're constantly just finding new solutions that help them break through the barrier, whether it's getting your second, your first, your fifth, your 10th, or in some cases your 50th, where we're here to help you find solutions as your portfolio evolves.
And Hart Togman, obviously a coworker of myself at Rent Panda, and I'll be the moderator for tonight. I should have introed myself as well, but Hart, if you don't mind saying a little bit about Rent Panda, and then we'll get into the questions.
Yeah, sounds good. Hopefully everyone here knows a little bit about Rent Panda, but I'm Hart. I'm the CEO and co-founder, and essentially Rent Panda is here to be the rental expert and help steward the journey of small landlords, building products and providing services to help small landlords succeed.
Thanks, Hart. So, you know, first and foremost, as a lingering question, I'm sure everyone wants to know about, you know, I really direct this to Alex at this time with rising interest rate and obviously the Bank of Canada news. You know, the very basic question, which is really not basic at its core, is now the right time to buy? If you don't mind just providing a little bit of context on that, and then we'll kind of work from there. And again, for anybody who joined either late or earlier, we try to make this pretty conversational. So if any additional questions or builds come up, please put them in the comments. We'll try to address them as the conversation organically builds. And if we don't get to it, we'll try to provide those answers or those details after. It might be a direct connection to Alex or Hart or a combination of the two, but we try to make sure that we answer everything that comes in, especially if you're participating in the conversation. So Alex, on to you about now is the right time to buy?
Yeah, I think, the $1 million question, right? From the perspective of, let's say, real estate investing, I think now's an interesting time because you've got pretty heightened rents relative to where it is. So like going in, you're able to lock in a pretty good price. And then I think, so our outlook is that the housing market is more or less bottomed out. So Q1 2023 and Q2 is where we think things will kind of start to flatline and then even reverse. So on our side, we're seeing a huge influx of pre-approvals from purchasers, both buyers and real estate investors and first-time home buyers. So we think now is a good time to get ready to buy because we don't think there's going to be a lot more downward movement in prices. And if anything, there's just everything that's pointing towards high demand and low supply in the near future. So we do think now is a good time to be getting ready to get into that Q2, Q3 market before opportunity passes you by.
Fair enough. Yeah, definitely a lingering question right now for a lot of investors about, you know, it's always like, is now the right time to buy? And then it comes up, you know, obviously every so often. Just in terms of your outlook on mortgage rates, for those that are unfamiliar, Perch released and we'll provide it in the, you know, in a post email to all the attendees, but essentially an outlook on mortgage rates for the next 5 years. But Alex, if you don't mind just providing a little bit of detail on, you know, where you foresee the outlook on mortgage rates.
Yeah. And this kind of ties into the right time to buy as well. So really our outlook on rates is that it's going to be fairly flat. So the Bank of Canada just increased rates by a quarter point. I think it was last week last week. We think that's their last one for the year, and they should be holding steady for pretty much the remainder of 2023. They might even start cutting them by the end of this year, where we don't think it'll be dramatic, like maybe like a quarter point kind of thing. But the rates in the market, and as you'll see in our outlook, is that rates are expected to drop about 2% over next year. So that's going to be a massive massive release if you're in an adjustable rate mortgage on your payments. So where rates are now expected to kind of stabilize at the 3.25 range for that high ratio. So for real estate investors, probably closer to, let's say, the 4% range on a rental property. So that's going to be a lot of relief for many people that are in adjustable rate mortgages. And that also then ties into, you know, the good time to buy question, because I think a lot of people will really look at the cash flow as in regards to the opportunity, but where people have that cushion of extra equity to really go through what might be a negative cash flow position until the rates come back down, there's an opportunity to really realize a lot of capital gains that'll kind of make up for the negative cash flows in the short term. So it's rethinking kind of how you're going to make your returns on the property versus what you might have historically been used to.
Yeah, that's fair. Absolutely. We have a couple questions that have come in, so we're going to go forward first and then back to the previous question. So the first one is, how do I know if I have an adjustable mortgage? So just a very simple question about that understanding there.
Yeah. So funny enough, a lot of people just think like variable rate mortgage is there's actually a variable and an adjustable rate mortgage. So the easiest way to tell is if you have a variable rate mortgage, every prime rate hike largely hasn't impacted your mortgage payment, assuming you haven't hit your trigger rate. If you have an adjustable rate mortgage, immediately in your next payment, you'll see that your payments will change. So in a variable rate, your payments are the same, but your amortization will adjust based on where rates go. In a variable rate or an adjustable rate, your payments change and your amortization stays the same. So in this market, it would have been favorable to have a variable rate mortgage because you wouldn't have had as much of a payment increase as somebody who was on an adjustable rate that basically was nail biting every rate announcement as it directly affected their next payment. But with that being said, when you come up for renewal, the shock to variable rate mortgage holders will be dramatically more because they're going to basically absorb that entire increase in one go. Whereas at least in an adjustable rate, you've had time to adjust your budget and your cash flows to essentially account for the new normal that you're in.
Yeah, as we talked about earlier, yes, I am in that situation of the adjustable side. So yeah, we'll feel the pain for a bit. Just going back to the previous question, just a direct message to myself. So what economic signals are there that tell you it's the right time to buy?
So the first one being the reversal in interest rates. So one of the largest reasons why like house prices really came down pretty dramatically, or not dramatically, but let's call it like 15 to 25% on average, and some areas maybe more, was essentially the rapid rise in interest rates. So that put off a lot of people from an affordability standpoint, but also psychologically, where it's the same effect of a crashing stock market where everybody wants to see how low it can go before they go in. So you've got that dynamic, which really kind of led us to today in the last year and a half, call it. And now you've got a reversal of it where rates have, let's call it plateaued. They've already started to come back down. So we've got rates in the fixed side going into the low 4s to mid 4s, whereas even a couple months ago, they were in the 5, maybe even mid to high 5s. That's one element. And then from another one is essentially we had record immigration numbers last year. We're going to have record immigration numbers this year. You then have people that are going to stay put because they don't want to break their mortgage and go into a new rate, which puts a damper on resale volume. And then a lot of the construction projects were essentially stopped during the last couple of years because of increased labor costs, shortage of materials. A lot of the things that impacted renovations in general were also affecting the construction side. So that is going to lead to less inventory later. So really, there's no reason to think why we won't have high demand. And then also, like what has always plagued essentially many parts of Ontario in the past is low supply. So all things kind of point in one direction, and it's just not a matter of if, it's just a matter of when.
Yeah, fair enough. Okay, so I think one of the big questions that definitely comes up in terms of mortgage renewal, if my current mortgage is ending this year, what are some things I should consider before renewing?
Yeah, great question. So basically, this touches on one of the questions the audience asked actually. So if you are in a variable rate mortgage, you would have had the benefit of essentially seeing your payments stay steady as even or absorbed enough of the hikes, even as you likely would have hit your trigger rate at some point. But that at least helped cushion some of it. So now if you're coming up for renewal, you might want to seriously consider if you still want to be in a variable rate mortgage, because if rates are going to come back down, would you want to be having your payment go down with it? So maybe an adjustable rate actually might be better on the way down. Or maybe you've had enough of a roller coaster ride and you want to go into a fixed rate. So really reevaluating, is your rate type still the right fit for your investment profile, or also just your personality, or not personality, but let's call it preferences. And then I think the second one would be if you need to switch to another lender. So a lot of people might have gotten like, and again, there's nothing wrong with going for the lowest rate, but if you found that throughout these processes where you essentially needed equity out of your home, or maybe a bit more flexibility in regards to terms, you could have really benefited in the last year or two from having something like a readvanceable HELOC, where essentially all your principal payments could have been taken out of your property, or you could have tapped into your home equity when you needed it. So switching to a lender that offers a product like that might be something you want to consider. And then lastly, if you wanted to have, or you're thinking of expanding your portfolio, instead of renewing, it might be worth refinancing and looking at how you can get some of that equity out of your property without having to pay additional penalties to do it by breaking your mortgage after the fact. And I see a question from the audience of like a 1-year mortgage, also considering what term you want to renew at. Just because you got a 5-year fixed when you got in doesn't mean you need to renew into another 5-year fixed. So if you think things are going to change, you can get terms as early as 6 months and as late as 10 years. So there's really a lot of flexibility there. So definitely chat with your mortgage advisor in regards to what's your goals and how does the product mix really align with that. So when your renewal is coming up, it's something that you can take advantage of, or else it's going to cost you a lot more later if you don't think about it to break out of something that's going to be more punitive.
Yeah, like we go back when we had a conversation just in general, it's like look at holistic budgeting across the board, agree with the goal side of things, because they're going to work together, in combination to say, okay, exactly that, if I want a fixed rate, it's really just, okay, I want to have a maintained payment for X amount of time versus, I'm willing to play the up and down, hopefully down, and, have that conversation over the 1, 3, 5 year, whatever, is decided in the end. So totally get that. Just in terms of, and Kesha, hopeful that we answered that. If not, definitely write in the comments, or feel free to unmute yourself. It's not like everyone's muted permanently. You can definitely ask the question if there's a follow-up on that. In terms of unexpected costs for investors, can you go through like just a high level of some unexpected costs that they may see, just in general?
Yeah, no, I can touch on that. So a couple of the ones, just thinking back to like the conversations I'm having with some of our clients. So the first one, this is actually one that hasn't hit people yet, but that is something that like that might be an unpleasant surprise in the next couple of years. So many of you might have read about the expected huge tax increases on the property tax side that some municipalities are going to experience as a result of the cuts that they made to a lot of the new development proceeds that usually go to the cities. So like the range of percentage increases is pretty dramatic across some of the cities. So some people might see property tax hikes as I think it was 35% was on the higher end. So that's something that would probably be an unexpected tax hike, and also not normal and by any way, shape, or form. It's going to be more of a one-off. And one other one that we're seeing is renovations. Even though they're starting to normalize a bit more, there are still a lot of projects that are either going way over budget or like way over time. So time, particularly on the real estate investment side, is much more punitive because, if you're a first-time home buyer and you wanted to redo your bathroom, you can still live there, not a huge deal. But if you're an investor and it's going to be material renovations, not only is it going to cost you more, but every day that you're not renting that is going to be something that eats into your capital. So we're seeing a lot of delays still eating up into how quickly they expect it to get to market. And lastly, there are a number of, with high inflation and a lot of the layoffs that we're seeing recently, there are some use cases where there are tenants just not paying rent, and there's still a huge backlog with the tenant board. So I guess as much as maybe that's not an unexpected expense, it's more of an unexpected loss of revenue, which I think is equally material. So those are some of the things that are top of mind with some of our investors.
Yeah, absolutely, fair point. Yeah, still a long line for the board for sure. Just in chat, so I'll just read it out to you just for exact context. So from Sean, it's when does it make sense to borrow against the equity of an existing property for the down payment of another, or is this a bad idea?
Yeah. Okay, so I guess there's really two use cases. So many real estate investors. So this is like when if you're coming up for renewal and it's going to cost you nothing to take the equity out of your property and you can reinvest it. So obviously the cost at which you borrow is going to be something that'll impact your ROE. But it's always something to look into because one of the core things of real estate investing is leverage. But obviously you don't want to over leverage to the point where you can't sustain your expenses, but where you're able to, you should use leverage to expand your portfolio. So borrowing equity typically could just be as simple as going to the 80 LTV, taking that equity out and then using that as your down payment in the next property. But what we're seeing a lot of as well, so this would be like your best case or base case of leverage. But what you're also able to do, and what we've seen some investors do, is if you don't have, let's say, the 20% down to get into a real estate property, or you're going to do a property that has a lot of renovations, people are leveraging second mortgages, let's say on the other property where you don't have to break your first mortgage if you have a really good rate, just to get that equity out now to start the project and then refinance and pay it out later. Or you don't even have to get a second mortgage, let's say on the home you're buying, you can actually just blanket any of your other properties to use that equity against your next home. So think of a blanket mortgage as like you've got a pool of properties, some of them have excess equity, and you can just basically put those up as collateral to reduce how much down payment you need on your next one. Blanketing is typically going to be something you only see in private financing. It's very rare that I don't think you'd ever see it with A lenders or B lenders. But something to think about, because especially if you're going to do renovations and it's going to be a quick flip, you might actually be better off just getting a 3 to 6 month private, completing your work, and then refinancing out into an A or B lender to reduce your costs.
Great, that was very in depth. Thanks. And Sean, if you have additional questions, feel free to raise your hand and we'll unmute.
And actually, sorry, I see another question. I think somebody wanted 1 year rates. So Keisha. So just to give you an idea, yeah, 1 year rates for rentals right now would be somewhere around 6.1, 6.2-ish.
You still have your hand raised. You feel free to unmute yourself if there's additional context you'd like to ask as well.
Yeah, thank you so much. Good information, guys. So I'm new to Rent Panda, but so my question is, I do have several properties. 2 of them I have a second mortgage on. One of them, the second mortgage is coming up for renewal. Now I prepaid it for a year, which means I can't prepay it again for another year to suffice. Now that the property value has gone down, trying to refinance and put in that second mortgage together, does this mean that I'm gonna be out of pocket? Because if the value of the property is not at where I thought it would be, and then when I refinance, it's gonna eat up a lot of equity that is inside the property already. I might have to spill over some money. So I wanted to know if it makes sense to get another second mortgage to pay out that mortgage that I take out and prepay that mortgage for another year.
Yeah. So the one caveat I'll give you. So without knowing all of the details, I can give you like general advice in regards to that situation. So when you have a second mortgage, that like really the 2 things that are going to be working against you in this case is that if you had it prepaid, it essentially helps you from a cash flow standpoint. So I'm assuming when you say prepaid, as in like the commitment fees and the interest were all baked into your LTV. So that helps because you don't have to service it essentially, where there's no additional payments. But the downside is that it accelerates how much of your LTV it eats into, so that if your property value isn't depreciating as much as, like, let's call it the second mortgage would fit into it, in this case, when property values have come down, it essentially compresses your LTV. And on top of that, you've got real estate investors and private mortgages that have also scaled back their risk appetite. So a year and a half ago, you could have seen 85, maybe even 90% loan to value, that like people would go up to that much. But today, the more it's like, I guess 70 is the new 80, basically, where everybody has kind of scaled it back. So where that's going to affect you is it might limit how much of the LTV that people are willing to go into. Or so essentially not being able to put it back in, you then have to look at, like, are you able to finance it? Because ultimately no lender, whether it's an A lender, B lender, or private lender, wants you to foreclose. They're going to work with you to figure out how to make it work. So now it's just going to be a matter of essentially figuring out which terms align with the cash flow of the property. And in the very worst case scenario, then you might have to look at what you're going to do with that property. So whether it's selling it completely or maybe bringing in a partner or somebody that can offset some of those cash flows and seeing it what makes sense. But I would strongly recommend essentially like having a more in-depth conversation with a mortgage advisor that can look at qualifying income, the whole picture, and then give you something that's really kind of fit for your strategy and your profile.
Hopefully
I hope that answers your question.
I think it overcomplicated it, but I understand the concept of it and where it's going. Okay. Alrighty. Okay. Thank you so much.
Yeah, no worries. Thank you.
I think the biggest takeaway that probably Alex or ourselves would talk you through is that every case is very specific, and you kind of have to know all the details. That's what Alex was saying. We're just trying to be general on things. But for sure, if there's follow-ups, we'll leave everybody's contact info at the end of the meeting and, direct information. So if you wanted to reach out after the fact for a more in-depth conversation, for sure, feel free to do so. I think it's a good segue to, saving money side of things. So I'll push this one to Hart from Rent Panda, just in terms of, cost saving. Is now the time to be self-managing to save money?
Yeah, it's a question that we get probably every single day, because a lot of people are gun shy of property management because it is typically the largest monthly cost that you have to allocate if you are self-managing, or if you are having a property manager manage your place. Three questions you need to ask yourself as an investor. The first is, do you have time and bandwidth to properly manage your property? And that's, handling tenant calls, repair requests, those late night requests, and being always on, not taking that vacation or having someone cover for you. And you want to assume a few hours a week of management work per property. And that's just, phone calls, triaging, not going out there yourself and dealing with repairs. The second question to ask yourself is, are you local? Doing things like fire alarm inspections, move in and out inspections, your winter inspections, dropping into a property to check on the tenant, dropping in to determine if work is actually needed. Those things are really big time sucks. And you want to make sure that if you are self-managing, you can do them, and be honest with yourself. Because if you're not local, you have to allocate travel time, and a property manager may make sense when you look at your hourly rate. And then the third thing to ask yourself is, do you know how to attract and screen tenants? Something that a lot of landlords forget to do is to properly allocate time to educate themselves on how to screen tenants, time to actually do the advertising of the property, the management of showings and messages, and actually screening people, not only building leases and collecting rent. So typically you should allocate about 15 to 20 hours of time on the conservative side, and about $200 to $300 in hard costs to actually place a tenant if you're going to be doing it yourself. Or you should look at a couple other options. You could look at a leasing service to place a tenant, and then you can self-manage, collect rent, deal with those phone calls. Or you can start to look to property management companies, which will typically charge between 5 and 10%, depending on your region, to do all of that work for you. So just really question whether you have the time, the effort required, and the education about being a landlord and managing to self-manage.
And I'll do a plug about Rent Panda, but just in terms of leasing services, I know how you mentioned it, but for anybody who's new, and I caught that comment earlier that a landlord or investor, you're new to Rent Panda. We do a leasing service across Ontario in many of the markets, not just the major ones. And we've been doing this for going on 6 years now. Various different, tenants or situations that we've dealt with, from students to multifamily to single family homes. So definitely get in contact with us if you want somebody who's an expert to handle it. Otherwise, we're happy to have just a general conversation and see what's right for you along the way. We're going to move to vacancy rates. That's kind of an ongoing topic that we get asked about a lot. And I'll put a link for everybody in the chat for our rent report. So Rent Panda sends out a rent report. We just did a recap of last year as well as December 2022. So you can definitely check it out. But really, Hart, if you don't mind just speaking to really, the low vacancy rates, and, is that really even a thing to kind of have a conversation about and worry about?
Yeah, for sure. So if you look up rental calculators online, or, assessing a rental property, obviously your mortgage payments are going to go into that, as you're going to have to speak to a mortgage expert to figure out all of those costs. But vacancy rates are costs that are typically built into one of those rental property calculators. And a lot of people are asking us, with vacancy rates so low, do I really need to account for it? CMHC just released their report and they're showing 1.9% across the country. And the reality is CMHC is highly skewed data that surveys purpose-built apartments that typically gravitate towards highly dense urban centers where vacancy rates are truly lower. There is less rental supply, higher demand, obviously places like Toronto, Montreal, Vancouver. But when you look at a lot of tier 2 cities, which is where a lot of our audience and hopefully a lot of people tuning in today are owning and managing their properties, the vacancy rate can be much higher. It can be double that. We can look at 4 to 5% vacancy rates in those markets. And when you're looking at investing in a property, you not only have to look at the exact vacancy rate, but you want to take your property into consideration. Did you buy a property that is empty and is ready to go and you just need to fill it? Obviously, that's going to take usually 2 to 4 weeks to fill a vacancy. But if it needs extra work, you should allocate for that. Sometimes we work with investors to actually get into the property before closing to take photos and videos and start to advertise the property. So you can shave some time off there, but you need to allocate some of that time and the time to fill that vacancy. And then when it comes to vacancy, if you are using a leasing service, you want to make sure you build in the leasing fees into your costs. And so typically a property will turn over on a 18 to 24 month basis. With rental rates going up so fast, you don't really want a tenant who's going to stick around for 5 to 10 years anymore. You want someone that's going to move out after 2 or 3 years. So just really take into account the specific vacancy rate for your market. Take a look at the rent reports that we've been putting out. Take a look at CMHC in your specific market, and then evaluate your specific property, and don't just use that kind of blanket number of 1.9%. It's typically closer to 4 or 5% vacancy costs that you want to be allocating for a property.
Speaking of budgeting and kind of taking a step back, there's two kind of questions that are definitely identified as similar in terms of saving money. So one being, what's a reasonable repair budget to factor into your cash flow analysis? We'll touch on that, and then I'll get to the second question after, which is still related to the cost saving side.
Yeah, for sure. So it'll totally depend on obviously the age of the property and the state of the property. The general assumption that we're going to make is for new properties, allocate to about 3 to 4% of your monthly rent into a repair budget. And for older properties, about 6 to 8%. Obviously, that's dependent on the property. But when you look at your repair budget, you want to obviously evaluate whether you're going to be doing the work or you're going to be hiring out the work. So are you handy? That's the number one way to reduce your costs if you are self-managing. But little tricks of the trade to decrease your repair budgets and bring that number down, hopefully to that 3 to 4% range. The first thing is install pin pad locks. About 30% of all service calls that we see relate to locks or keys or some sort of gaining entry to a unit. So a $200 investment when you first get a property in a pin pad lock is really, really important. And so definitely do that. Get rid of that 30% right away. When people move in, provide them with the basics, and specifically plumbing basics. So providing tenants with a plunger and a little bit of Drano, and checking your flappers that they're all in good shape, and using the little food coloring test to make sure your toilets are working. That's another 30% of service calls that we see all the time for toilets. So make sure your toilets are in order when tenants turn over, and you'll cut down on that repair budget. And unnecessary calls to plumbers, which are typically expensive, and those calls always come in after hours, so you're paying emergency plumber calls or plumber fees. And then you want to create an easy to use process for tenants to report a repair request. So you want to have a digital form for them to fill out and send through to you. Don't take texts, don't take phone calls unless it's an emergency. Have them fill out a form and send it through. A little bit of extra effort, don't make it too hard, but a little bit of extra effort will mean that they're putting in the right details and they're not just reporting every little thing. And then make them include a photo or a video. And then if you have any questions about it, call them afterwards. So don't go out to the property, don't waste your time. Your time is the most valuable thing. Have a call with them to actually talk about the issues. Sometimes you can talk them through a quick fix. Sometimes it's a stuck flapper, and that's all that you need to do. But make sure that you have a system in place for reporting repairs, and you can cut down on unnecessary service calls, which are often quite expensive.
Yeah, definitely the emergency calls for, lost keys or whatever happened to them, and then plumbing for sure. Absolutely. Just in the chat, can you write off your own labor cost if you're handy?
So definitely talk to your accountant, and hopefully you have a specific real estate accountant. Generally, you can write off any supplies that you buy. Your time would depend on if you're a registered trade or not, but definitely talk to your accountant in your specific situation.
Okay, great. Michelle, if there's any follow-up questions, definitely send them in chat and we'll try to answer them. And then a second question, it's definitely a different topic altogether, but again, going on the factor of saving money. And we get this question all the time, to be honest, during leasing contracts is, can I make my tenant pay for all the utilities? Obviously, trying to save money on that end. And really what you're trying to do is limit risk of, what is essentially a variable cost, right, per utility and how the usage is. So if you don't mind touching on that, that'd be great.
Yeah, for sure. So when a lot of new landlords get into their first or second property, they assume that they can always place the utility bills on the tenant and they can transfer utilities into their name. And they assume that all the utilities for the home are going to be covered by the tenants. It really depends on the property that you've purchased. And generally it falls into three different categories. The first is, if it's a single family home or a separately metered duplex, triplex, any multiplex, you can have the tenant transfer the base utilities into their name. Be careful with hot water tank rentals or water softener rentals in some municipalities. A lot of providers don't allow the transfer of those items into the tenants' names. And generally, hot water tank rental, water softener rentals, water softener salts, those are things that tenants aren't expecting in their budget. And so it's easier to just roll that into the cost of rent. Assume your hot water tank rental is going to be on you. And most tenants think about utilities as, their standard hydro, water and gas, or hydro, heat and gas. So hydro, heat and water, apologies. So you want to make sure that those three are put into the tenant's name, that you receive proof of utility transfer before you hand over those keys. And you can always call the utility provider to ensure that that's done. And so that's for separately metered units or single family homes. If there aren't separate meters and it's a multi-unit property, you want to allocate a percent of the utilities based on the property. If it's an up-down duplex where it's a 2 and 2, you can do a 50-50 split. You don't have to go with an age-old 60-40 or 70-30. If you have a widely different number of tenants in the upstairs versus downstairs, you can do a per person amount. But you just want to make sure that it's fair and equitable for both sides of the tenant. And you can keep the utility bills in your name. And so that's typically the easiest way to do it. Avoid putting the bills in one tenant's name. We always see this with up-down duplexes where the top level is a main floor and an upstairs and the bottom is a basement. The upstairs tenant puts the utilities in their name and then gets into a dispute with the downstairs tenant when they send through their bills because they argue about who's using what and that it's not fair and they heard them running the dishwasher late at night. It just causes tenant disputes, and that is going to be the bane of your existence as a landlord. So keep the utility bills in your name and send them through the bills on a monthly basis and build that into your lease and your lease appendix, that the bills will come through on the 10th of every month or whatever it is, and they need to be paid within 24 or 48 hours of receiving the bill. It just keeps everyone accountable, and it's a much easier way to streamline things. And then the last way to do it is to include utilities in the rent. And in this way, sometimes if it's a little bit ambiguous in terms of how to split it, you can just charge people, $150 flat fee for those utilities. And you want to make sure that you can reconcile at the end of every month or every quarter or every year. And so you can, but it's typically not advised to say to a tenant, I'm going to charge you $250. If you go over, that's my loss. And if you go under, that's your loss. It kind of builds that contentious relationship. You want to make sure you have amicable relationships with your tenants. And so what you want to make sure is you're reconciling at the end. And it's going to be fair. It's going to be equitable. You're going to keep a copy of the bills. And in that way, you can get that upfront payment, and then you can reconcile after a certain period. And you can write that all into your lease and your lease appendix. You want to make sure that you are very, very specific. And again, those are for the three base utilities. you want to make sure that that you're not including anything that isn't allowable with your hot water tank rental or your water softener or anything like that. And any filters or maintenance or things like that that you need to do, that's typical wear and tear that is on the landlord as part of the RTA, on the landlord to cover on a monthly basis.
Yeah, that's great. Yeah, good detail, Hart. And just in terms of, building on the water tank side of things, right? The Ontario Standard lease really doesn't have that line item that's also there. So if the unfamiliarity from a tenant's side really about that cost, we definitely advocate for rolling that into whatever the rent is and considering that cost as part of the rent. So I'll go to Alex first, and then I'll go to Zach. So Alex, I know you had your hand raised.
Yeah, just a quick comment, because I see a lot of this sometimes where landlords kind of are going to push out a lot of expenses and then they kind of adjust rent to make up for it. So when you're qualifying with a lender, they're going to look at rent and then they just make an assumption on utilities. So typically it'll be $100 for a detached or 80 for a condo. So even let's say if you're passing on $300 to your tenant, you're not going to get the qualifying income for it at all, versus if you charge $300 for rent extra, you'll get full credit as it relates to qualifying for more. So just something to think about, as well as there's a convenience effect, but you could end up like, if you're doing this for all your rentals, that could have a material impact of how much you can qualify for.
Yeah, it's a good point, because a little bit different, but Alex, when we were working through contracts with landlords and we're bringing tenants through properties, the age-old question is like, what is a general approximate cost for whatever those utilities are? So if you're covering 1, 2, 3, doesn't really matter. Every tenant's going to ask, okay, so there's a lawful rent, and on top of that, I'm going to pay tenant insurance. I'm also going to pay for the utilities. So what we ask, the easiest way to do it is for a landlord to get either the previous bill that comes in for all those utilities, and obviously it's going to fluctuate month over month. For example, like Union Gas might have a short month in the summertime, right? And in the wintertime, it's significantly more. But essentially, we average that out across the board and give the tenants, for example, those 3 utilities based on, I know it's based on usage, even if it's separate metered, it would be somewhere in the range of, 150 to 200, and they can budget appropriately, right? Because you don't want that to come up later on and start that relationship where it's like lawful rent plus your tenant insurance plus that lump sum for utilities. So totally get that. So I'll get to Zach's here. So I heard that water bills have to be covered by the landlord and can't be passed on to the tenant. Is that a myth?
As far as I know, yes. So some municipalities won't allow the landlord to transfer the water bill to a tenant's name. That's the case in Thunder Bay, where we started Rent Panda. So sometimes that is the case, and that can be misconstrued as the tenant can't pay for it. So ultimately, as a landlord, keep the bill in your name and charge the tenants for it, either in the way that Alex just said, where you roll it into a lump sum, or send them the bill on a monthly basis and have them pay for it. So you should definitely, when speaking to the tenants, let them know that the utility payments are going to be on them, but the bills may not be coming to their name, and they won't be transferred at the start of the tenancy.
Yeah, and I think it's just like back to the point earlier, if you're looking at risk level and saying, hey, I'm going to take on that bill myself, really looking at historical norms in terms of what that, like if you have multiple years, it's easier to determine what that utility cost is going to be in the end and make a judgment call from there, especially if you're going to take on that utility.
Yeah, and ultimately,
actually,
I mean,
go ahead.
Yeah, from the RTA's perspective, you can put those costs on a tenant. Municipalities are going to be different in terms of how they allow the setup of those utilities. So I'd say before investing in a property, make sure you really check in with the municipality. And something really simple to do is just join local landlord groups for that municipality and start talking to them. Take people out for some coffees, talk to them about their experiences, ask them how they set it up in that specific region. And you'll learn a lot from people who've been doing it for 15, 20 years in that region.
One comment I was just going to make regarding that. So all really good points. The one other one is that you can also kind of take it, you can make it your advantage in the sense of like costs of utilities, is that if people have an expectation that it should cost me $250 a month, but you're able to get, let's say, a ton of grants and subsidies to swap out that old furnace for a heat pump, get that AC into something more efficient, and you can make your effective utilities cost about 100, 150, then you're making 200, like $100 a month in profit. That essentially to them is not really real profit, because that's what they were expecting to pay from properties that might have been less efficient in the past. So there's a way to make it where it's kind of a win and you've minimized your risk since you're likely not going to dip into your profit.
Yeah, we've had tenants ask, just I don't want to deal with having the utility in my name, and I'm willing to pay more just to, you know, have that convenience of not having to pay the utility. So it's always an option as well. And again, like, yeah, it could be more or less depending on the month. So I'll shift a little bit into, like, this is a bigger question. We get asked this all the time, but you know, how do I assess rent in what is considered a volatile market right now? And obviously every city, whether, you know, it's big city, smaller city, or even smaller city on top of that, how do I do my rent assessment overall to make sure that I'm competitive in the market as well as, you know, priced appropriately for the unit?
Yeah, so this is the holy grail question for us as the rental experts, in the same way as, you know, is now the right time to buy for Alex and his team. When it comes to assessing rent, I will say it's more of an art than a science, unfortunately. But when it comes to evaluating properties, or if you've bought a property and you're not sure exactly what to peg the rent, there's a lot of tools out there to look to, and there's products and there's services that can help you out. So the first thing is check the data that's out there. Look at CMHC, look at Rent Panda's report, look at the other competitive reports, pull up all of the rent reports that you can for that specific area and really drill down into the numbers. You know, do your due diligence, do your homework on the data that's out there. Then look at what's actually performing in the market. So look at Facebook Marketplace, look at Kijiji, look at MLS, look at rentals.ca, look at Zumper, Zillow. Take a look at all of the platforms and start to build a good list of about 15 to 20 comparable properties and see what they're listed for. Two things to note with that comment, and I'll you know, juxtapose what I just said with another one. But when you look at 15 to 20 properties that are listed in their list price, if you see that those properties are on the market for a long time, a lot of MLS properties will be listed and sit for a long time. The same thing with Facebook. Those are going to be overpriced, and so you want to take all of the outliers, all of those high days on market properties with a grain of salt, because list price does not mean what is actual, you know, fair market value for that place. And you want to look at an area of about, you know, 10 kilometers or so from your property. And then the second part, and I'll contradict what I just said, but when you look at comparables, you're not always looking at, you know, the true definition of comparables. So a 3-bedroom townhouse doesn't need to be compared to a 3-bedroom townhouse. And, you know, landlords make this mistake all the time, but you really want to evaluate a comparable from the position of your tenant. And you're not going to have a tenant yet, but your ideal tenant that you actually think will rent out your property. Think about what are comparables for them. And so if you've got, you know, a property that's a 3-bedroom townhome to a group of students, that may be, you know, 6 people moving into a 3-bedroom townhome, and they're looking at various comparables. If you're looking at, you know, if you've got a 1+1, a young professional looking to move into that, it may be a true 1-bedroom, right? If you're looking at, you know, 2 international workers coming in, that could be a 2-bedroom. If you're looking at a young family, that may be comparable to a 3-bedroom. And so you really want to be conscious of who's going to be renting out your place and look at comparables in that sense, and not just peg yourself to, you know, my 3-bedroom townhome has to be the same price as all the other 3-bedroom townhomes out there. So look at all of the marketplaces, you know, Rent Panda, Kijiji, Facebook Marketplace, MLS, use all of those tools to your disposal. There's also true tools to evaluate rent. So Door Insight, who's one of our partners at Rent Panda, has a great tool to pull historical data and live data about rentals. And so you want to use those tools that are out there, and we can drop some links in the chat. And then if you really aren't sure, or if you just want to really hone in and group a lot of services together, hire an expert. You know, if it's your first time, if you don't know what you're doing, if you don't know how to screen tenants, if you don't know how to price a property, that may be enough to say, hey, I should go out and get a leasing expert to rent out my property. And when we evaluate properties, we look at all of the comparables. We usually look at 40 to 50 comparables, not just 15 to 20. And we use all of the tools at our disposal. And we'll likely have rented places in the area that are comparable really recently. So we can look at rented prices and not listing prices. And then the final point is to check back frequently. So we're in a volatile market. Prices in November were not the same as December and January, and we expect February to be very different. So we had a very slow rental market with lower demand in Q4 of last year. That demand has resurged in January. We expect it to continue to grow into February and into the spring. And so if you've had a place for a month or so up on the market, the pricing may be off. Or if you've looked at properties in December and now you're looking to buy again in January, don't assume that those comparables are the same. So you want to check back frequently. And again, go through that whole process of checking comparables, checking marketplaces, checking out the rent reports, and seeing what the new data is showing you.
Just in terms of a time, and I know we have a little bit to cover towards the end. Hart, I know you have the breakdown, so I'll make sure you're able to share your screen. And what we'll do is we'll pop something on screen for everybody. And what we can do after is we'll look at the recap note that we're sending out to everyone and see what we can include if everyone can't absorb everything right now or just wants a takeaway at the end.
Awesome. So what we were going to do is talk a little bit about a real property that was bought and rented almost a year ago now. And to Alex's point about is now the right time to buy, a lot of people were being pushed into buying when the market was going up, and then things changed and everyone is quite scared. And so we're going to take a look at a property here and just really evaluate whether or not it would still make sense to purchase this property. So I'm just sharing my screen now. I'll give a very quick recap into the property. But this is a Guelph rental that we ended up renting out to students. It was a single family home. You can see here it's a bungalow clearly. It was on a decent piece of land, and the investors purchased it, and their plan was to convert it into a duplex. Did everything legally, did everything right. So they purchased this duplex. They enlisted our services to lease it out. They did very well on it, and it's a really good performing property. But we're going to evaluate whether or not it still makes sense if this property popped up today. If you went to Alex and said, "Hey, Alex, should I buy this property? Hey, Hart, should I buy this property? Is it right to go forward with?" So I'll be quiet for a second. I'll let Alex jump into it and just evaluate some of the upfront numbers.
Awesome. Yeah. So it's because I think you were saying the interest rate they got on this back in the day was what, 2.2% or something like that?
Yeah, just over 2.2.
Yeah. So I mean, so it's got a pretty good cash flow at that point. So just to kind of paint a picture of how it, like essentially, so if your clients likely put down the standard 20% and then their renovations all came out of pocket. So I pulled rates based on today where that would be. So this would be a 5-year fixed rate, let's say at about 5.25. So your monthly payment would be just under $3,300, but I've put $2,600 interest only. And this ties into one of the comments I made earlier where, let's say if cash flow was an issue, you could pull the principal out of your readvanceable HELOC to make this effectively an interest only payment where your monthly mortgage payment is then $2,600. That's obviously only if you need to do it, because I think as you'll see later, these investors would not need to do it. But just to give you an idea of essentially the flexibility that's there. And then from a down payment standpoint, some of the things we talked about, let's say if the 150 wasn't there, you could have used a blanket mortgage, a second mortgage to essentially reduce or even get an advance on some of the renovations to reduce some of the costs or some of the equity needed up front.
Sounds good. And Alex, maybe to put you on the spot here, but if this was two investors coming together, what are the base criteria that you would ask them for in order to qualify for this mortgage?
Yeah. So basically, the first thing is identifying what's the pecking order of financing. So whenever possible, we always try to go A first, then it'll be a B/alternative lender as a secondary. Then we'll look at private. Very rarely do we look at private as a standalone solution. So it's typically meant to be something quick. Like if they're going to dramatically renovate this property in like a 4 to 6 month period, then we might do it all as private. Otherwise, we're typically looking as private as a second mortgage behind a lower cost facility. So the first thing that's really going to dictate a lot of how many financing options they can do is going to be the structure. Somebody buying this property personally versus in a joint venture or a corporation or whatever it might be is going to dramatically impact how many lenders would look at it, especially on the A side. And then it's going to come down to just their overall qualifying ability. So these people might have great incomes, but if they already have, let's say, 6 rental properties, that might affect how much they qualify for, because on the A side, it gets extremely hard to qualify for more properties as you scale, because they'll only take 50% of your rental income. So it'll be helping our clients essentially go through that evaluation process, seeing what makes the most sense of, do you just go A with a private, do you go B, do you go this, and then kind of figuring all that out. Or even in some extreme cases, like we have clients that want to scale their properties like from 50 to 100. So it's like, what do you do then? So that's a very non-traditional approach. But we've found success where, if, let's say on the personal side, you're fully maxed out, we're able to actually roll your properties into commercial facilities where it's then actually not even like your personal situation is hardly relevant anymore. It's purely based on the cash flows of your portfolio. So that's where people can scale it to quite large increments.
Awesome. So yeah, I mean, obviously, as a layman looking at a 3292 mortgage payment is pretty substantial. This is a relatively small property in Guelph, but surprisingly, this place actually rented out for $47.50, and then the tenants covered utilities on top of that. And so through our leasing team, we identified that this would actually be a great property for students, and a lot of international students came through the university. There was an over-enlistment in the university, and prices went absolutely through the roof in Guelph. And so we were able to bring in $47.50 gross for this property. So numbers start to look pretty good as we go down through the list. Even with insurance costs, even with tax, additional utility costs for that hot water rental and for the water softener, which is pretty common in Guelph, with a repair budget in there, and with leasing fees built into the monthly costs and a vacancy fee, assuming turnover every 24 months, this property still looks pretty good for an income property in Guelph. So on the very, very conservative side, we're positive cash flow, $333 a month. And if Alex works his magic and it makes sense for the landlords, we're looking at over $1,000 positive cash flow on a monthly basis buying this property today in Guelph. So obviously the landlords were very lucky. They made some good moves. They're very smart guys, and they made this purchase about a year ago. But even today, if this property popped up on the market, it would make sense. And we're not even going to talk about, cap rates and appreciation and all of the long-term plays for this property. Just from a pure cash flow perspective, it still makes sense. And I think the underlying tone is, landlords, investors don't need to be afraid of buying in this market. And there'll be some follow-ups afterwards, but the market is still looking good if you can find those deals, and if you can work with a strong team who can advise you of the right way to do things.
Yeah, and then just on that note, in regards to, like, you can create the additional units within the home, but a lot of the regulation that's come out has also really enabled garden suites and laneway homes, a lot of these other units that traditionally wouldn't have been part of your plan. So that's just another angle of another opportunity to further increase rents.
Yeah. Awesome.
Great.
That's a hell of a find. $47.50.
Yeah.
In Guelph.
I think we all wish we got that property, but yeah.
We have a little bit of time. We might go a little bit over 8 o'clock just for everyone that's here. Just a few minutes over, because we just want to touch on 2 additional things. So one question that we get asked, a little bit of a different change in topic, is how can I make sure my tenant pays rent? So Hart, that's definitely directly towards our business, what we work on, and the landlord questions that come through on our end. You're just on mute.
Awesome. Thank you. 2.5 years on Zoom and can't figure it out. So I'll preface my short answer with, we will definitely have an entire webinar about screening tenants in order to find high quality tenants that lower your risk of non-payment of rent, of tenant caused damage. This is an art, a science, a full-time job unto its own. But really, you want to make sure that you are attracting the right tenants from the start. So buying the property where you've identified a tenant profile that you want to manage, making sure you're realistic with yourself about the rent that you're going to bring in, making sure that you advertise the property correctly, you spend time on photos and videos, you write the ad in a way that is going to attract that tenant that you want, spending the time doing the showings, handling the messages, or hiring it out and screening the tenants, being really, really diligent about your credit checks, pulling them yourself, your background checks, your income verification, all your calls to past landlords with the right questions, using every trick in the trade to properly screen a tenant, verify IDs. And then once you do have that tenant, creating a really bulletproof lease with a strong lease appendix that can eliminate all the gray area that unfortunately exists within the RTA and the Ontario Standard Lease. So that lease appendix is worth its weight in gold. And then having the team to back you up. If things do go sour, have the paralegal that you can call. If you're using property management, make sure they have a system in place to deal with any arrears quickly and efficiently. And as a landlord, if you are self-managing, you want to start the relationship off right. Landlords that look at their tenants as commodities often will fall into the category of landlords that have issues. And so if you think about your tenant as a stakeholder in your asset, as a JV partner, essentially in your purchase, that will really start the relationship off right, because ultimately your tenant is going to be paying your mortgage, right? Your tenant is going to be your revenue stream, your cash flow. So you want to make sure you enable a strong relationship right from the start, and be a good landlord. Tenants often stop paying or turn into bad tenants because they're trying to get some sort of retribution for something they think you've done wrong. And so if you think about their needs first and your needs second, you will actually fulfill all of your own needs by getting that rent paid and getting a tenant who won't cause damage to your unit. And ultimately, that's what everyone's looking for, right? If someone paid rent on time and they move out and your place looks exactly as it did when they moved in 2 or 3 years ago, you're in good shape. And ultimately, if you don't know how to do all these things, if you're worried about a non-paying tenant, A, hire a professional, and B, pay for rent guarantee insurance. That product exists out there. Hopefully you don't need it if you're hiring a professional or if you're educating yourself on how to properly place a tenant. But products and services exist out there to ensure that your tenant pays or that you have income coming in on a monthly basis.
And just in the chat from Michelle, so where can I find the lease appendix?
Yeah, so a lot of paralegals will charge a lot of money for a lease appendix. If you build your lease through Rent Panda, which is actually free, there's a free standard lease appendix that's included. But essentially, for anyone at this webinar, if you email us at hello@rentpanda.ca, we can share our lease appendix that's built by our paralegal with you. And with our leasing service, we actually build a proprietary lease appendix for every single property. So our paralegal works with our leasing team to make sure that your specific property and any clauses that are needed for your property to protect you are there. So I would say, even though there may be standard lease appendices out there or clauses that you want to add in, you want to make sure that you consult with a professional to make sure that your property doesn't need any extra clauses. So shoot us an email. We're happy to send that through, and happy to also, advise on things. And yes, Michelle, so the Ontario Standard Lease, it's a good document that exists that the government has mandated every landlord use, but the Ontario Standard Lease is by no means the cumulative lease that you should be using. Landlords that have been in the game for a long time, and us, we've done hundreds and hundreds and hundreds of leases. We will never put through a lease with just the Ontario Standard Lease. You're able to add addendums, you're able to add clauses to that lease at your discretion within the guidelines of the RTA. So what you do want to make sure is that you're not coming up with your own clauses that you think should be in there and that the tenant should abide by, because there are clauses that are unenforceable. And there are clauses that if you put them in and they're unenforceable, if you do end up at the LTB, an adjudicator is going to look at your lease appendix and say, this landlord is trying to screw over their tenants. There's a lot of illegal things in here. And so you're going to be frowned upon for having done that. So you really want to consult with a professional about that lease appendix, and definitely don't just use the Ontario Standard Lease. You have to use it as a baseline, but don't just use it.
Okay, so hopefully, Michelle, that answered your question. If you have any follow-ups, let us know. And for sure, if you want to have a conversation about the appendix, we'll drop Hart's contact or my contact at the end of this as well. So I'll switch it out because we want to handle one more topic, and I'll put a link in chat here. So for anyone that wasn't following the Bank of Canada news last Wednesday, we're going to provide a link in chat from Perch's website where it really talks about the updated forecast of a 5-year variable mortgage projection, and I'll stop there. And Alex, if you want to build on that or anything additional context, in addition to the link that I'll put in here.
Yeah, no, I think it touches on some of the points that we discussed in regards to how your cash flows are going to change over time, depending on the type of mortgage you have. So we update this forecast every month, and then we show a little bit of the historical, so you can see how the expectations change. So I think overall, like whether you're in a fixed rate or variable rate, it's still useful information to get a sense for what direction rates are going in, and then that'll obviously have an impact on the price of housing in general. So yeah, just something to kind of keep as following the rent insights that you guys publish, following the rate insights that we publish. Those are part of the monthly updates that people can keep checking in on.
Great, thanks. We're going to wrap things up. Really, if anybody has any additional comments in the chat, we'll definitely answer them right now if we can. Otherwise, what we'll try to do is answer some of the comments in the recap email, or again, if it requires a more in-depth conversation, I've just left Alex and Hart's contact in the chat. We'll also put that in the recap email as well, and feel free to reach out if you want to have a direct conversation. And just from everybody, from Perch as well as Rent Panda, Alex, Hart, and myself, really thank everybody for taking some time out tonight just to go through this conversation and be a part of the conversation. We're going to try to continue this series, make sure there's valuable learnings for investors and landlords. And if there's a topic that is interesting that you'd like us to cover, definitely reach out. We'll try to figure out, who's on that call, who's on the webinar, who's, providing insights, and we'll try to get an expert on board to answer some of those questions that you may have. But again, for everybody on the call, just want to say thank you. I don't know if Hart, Alex, if you want to add anything to that, but thanks to everyone for taking the time out.
No, I'll just echo what you said. Appreciate everyone's time, and it's always great to connect. Happy to share your topics with us. Like really, it helps us help you, right?
Yeah, Alex, you stole mine too. I was gonna say, if really, like we build these webinars for the landlord audience, and so if there are things that you want covered, we can build a webinar. We can bring in the right experts. We can have a long chat about it. So share your topics, and we'll host a webinar on it.
I saw, Dan, and we just saw your question there. The answer would be yes, but not the only thing to look at. There's several factors to look at as well. I think that probably is a larger conversation. Feel free to reach out, like I said, you can copy Alex and Hart, or if it's a direct conversation you want to have. And then Arun, for the rental guarantee, we don't have that product right now. It's out there in the market. So for example, you might hear a popular service like Single Key, for example. There's definitely that service. We know them very well. They'll have a conversation with you about how that works, whether it's, payment month over month, or a lump sum that you want to pay up front to save a bit on the front end. But definitely that product's out there. They'll have a customer rep or someone there who can help guide you through that, and especially what that impact means for the tenant that you're essentially wanting to have in your property. There's certain criteria that they need to qualify for, but they'll walk you through that step by step. If anybody has any questions, like I said, Hart at Rent Panda, Alex as well, and then myself. Oh, Kesha, sorry, we'll hit this question. Go ahead. You can unmute yourself.
Sorry. So I think I didn't get his name. No, Alex. Yes, Alex said that there is an ideal or a great income. The word great income came out at me, and I wanted to just ask, in refinancing or buying a property, what is the ideal income that an A lender or a B lender is looking for? If you're going to the application as an individual, or you're going with someone else?
So it actually, in regards to the let's call it the number of applicants or anything like that on the file, it won't really have an impact. It'll be more of just so on A lending, it'll be very strict in regards to what's defined as qualifying income. So I guess the ideal scenario would be the most cookie cutter of them all, because that's the easiest for them to kind of underwrite, where it'll be salaried, 2-year average, like a very straightforward type of application. Not to say that the other ones are impossible. It just essentially complicates where some of them will qualify. So some of the examples of where it can get more complicated is, let's say you're self-employed, paying yourself dividends from a corporation over various years. It's just a matter of like structuring that and maybe even in advance, helping you with your tax planning to get an idea of what that looks like, or how much dividends you should pay yourself. But really, I guess I always look at it the other way, where you set a target of what is it that you want to get from a rental income portfolio. And then you basically just work backwards from there. Okay, if this is how much mortgage I need to get that portfolio, how much income do I need to get that? And then figure out what the structure is to get there. Because then once you have that, then that's really kind of like the leading point from there. So yeah, I hope that clarifies, because it does always kind of have a trade-off of, if you're self-employed, do I just pay more tax, or do I just pay higher interest rates and save on tax? Like, it's a constant trade-off that we go through with our clients.
Hopefully that answered your question. If it hasn't, again, it's more of a direct reach out. Or I just sent you a couple details in the chat to check out, and we're happy to talk about any products that we have, or any partners we work with. We'll send a recap of the conversation. If anything comes up along the way that we can answer in that recap, we'll definitely include that in. And again, any type of conversation or subject matter that you feel is interesting and something you'd like to know about, please let us know. We'll try to set up an expert or two in the conversation, and have everybody participate along the way. So I'll say thank you again from everybody. It's been great, and we've had a lot of participation tonight, so we really appreciate it. And thanks everyone for taking the time out tonight.
Hi everybody, have a good night.
Thank you.
Have a
And
good night,
thanks, Rob,
everyone.
for moderating.
No problem. Take care, everyone. Thanks again.